Why have international stocks been better this year? What's your view?
I mean, there's two perspectives. You have to look at both on the left-hand side and the right-hand side. The left-hand side, if you look at what's happened in the stock market's perspective and macroeconomics perspective, firstly, in the US, you have the Mag 7, which has started to underperform. And part of that has been that they've had such a strong run. But now that's tailing off. What you require for them to go further is their customer base, which is international, to start growing. And then from that perspective, the Europeans, after coming out of their debt crisis in 2012 and going through these periods of austerity, have started to reinvest into their countries' infrastructure. And that's driving returns in there. Then you look at China, their property bubble that everyone was worried about for many years, starting into the mid-2000s, burst in 2022. So now they're coming out of their trough. So you have these two major geographic regions which are coming out of in recovery mode. Then you step back, what's happening here? What you're seeing is policy uncertainty in the US, a significant increase and a change in the way that we want to run our economy, that we envision how the global economy should work. And that in itself is creating significant amount of uncertainty and increasing the risk in the US assets. And one of the things that interestingly is historically the volatility index, which measures just stock market volatility, has always been higher than the policy volatility index in the US. It's for the first time that we're actually seeing policy volatility is significantly higher than the stock market, i.e. the stock market is yet to catch up on the amount of policy risk that's happening in the US.
I mean, I think it's certainly interesting when you look and you think back to kind of that volatility in April, and PM that I used to work with always said when you look at market volatility, liquidity is sold first.
Yeah.
But what's interesting is in times where assets are selling off, usually you'd see proceeds park themselves in maybe something that's a safe haven, like the US dollar. And what you didn't see is the US dollar outperform during that period of market volatility. The US dollar is down single digits on the year, closer to 10%. I think partly because of fears, getting back to something that you said about the US ability to be that safe haven. People didn't buy the dollar. They bought German bonds. They bought Swiss franc. They held cash. And that valuation premium, that strength in the dollar has been in part due to that global leadership in the US. Anything that you'd add?
My views on macro would be not too differentiated to any other expert out there. But what I think is interesting is that the economic policies that we put forward in the current administration, what we want to achieve in terms of moving manufacturing back to the US, increasing exports out of the US and buying and getting everyone else to buy more US, requires a weaker US dollar, or at best that the US dollar doesn't appreciate from where we are right now. And to me, that's where the crux of all this comes from, is if we want the policies to achieve the objectives that we want them to achieve now, we can't have a strong US dollar, because that just counteracts and will deflate away from growth and affect our GDP and growth rates. And that affects our deficits and so on and so forth. The ball keeps rolling. One of the fulcrums to this is that we can't have a stronger US dollar. And to me, that drives how we should think of what is likely to go forward. That if we want to succeed in our current objectives, we need at least neutral, if not weaker US dollar. But to me, what's more important than the US dollar as an investor is where valuations are at this point in time. Valuations, if you look at the current US versus the rest of the world, the US is trading at nearly 2 times PE multiple what the rest of the world is. To me, that differential, which is at its historical peak, if you need to go back many, many years to get anywhere close to this. To me, that relative differential is going to be one of the biggest drivers of what is going to happen to returns for investors over the next decade. The expectations that are built, that are implied by these multiples at US at nearly 30 times, is so much higher than what the expectations for international markets are at. So what you don't need for international markets to do is do really well to succeed. They just need to do slightly well. The US needs to do really well to justify its valuation. So we are, from a valuation differential perspective, expectations perspective, to me, that has to revert. And that, I think, is going to be the driver for the next decade.
So, it sounds like, and just to paraphrase, a pull away from the US as much as a push away into other parts of the world. Is there anything that you'd add about, you mentioned Europe being attractive as you saw sort of loosening fiscal spend. Any other, and you mentioned China, anything else we should be aware of happening on the global stage?
Well, look, I mean, one of the things that if you think about last 2 years, people were worried about elections. Elections have happened in Germany, elections happen in India. So what you have is periods where elections have completed about most other countries. So from a geopolitical risk perspective, that is lower. And we now know what the policies are going to be at each one of these countries. So where we have most uncertainty is in the US. Now, what that relates to and how that translates to these other economies is something that investors are grappling with and trying to figure out. But if you look at where everyone else is at, they seem to have put their cards on the table. And the cards, where they're starting from, they seem to be not bad positions.